Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 20F filing, which is basically an annual financial health checkup for foreign companies trading on US exchanges. It's like peeking under the hood, but get ready. This one is from a shipping company, so it's going to be choppy. This report is all about Navios Maritime Partners, a big player in moving cargo across the oceans. We'll check if this sea giant is sailing smoothly or if there are some icebergs ahead. Alright, let's get started. Instead of listing our topics, let's get a lay of the land. We'll be looking at things like how they make their money, what could sink their ship, and who's at the helm steering the course. First, a word of caution. This report contains forward-looking statements. Don't trust them too much. Essentially, management is making predictions about the future, and that future is anything but certain. Things like changes in trade, wars, pandemics, or even just plain old bad luck can make reality very different from their sunny forecasts. We're reminded that these predictions are not guarantees. They caution that actual results could differ materially. The biggest risks include the ups and downs of the shipping industry, particularly rates for moving dry goods, containers, and oil. It mentions the company's ability to pay dividends, which they call distributions, which is always important. Here's something to consider. The shipping industry is cyclical. This means that charter rates and the value of ships can go way up and down, kind of like a roller coaster, but with your investment. Trade with China is a big deal for them. A slowdown in China's economy or a shift in their import-straight habits could really hurt Navios. Many events outside of the company's control, including wars, armed conflicts, political unrest, or economic crisis, may affect the company. The debt covenants are also important because if they breach them, it may prevent the company from paying distributions. Let's see 29,694,433 common units outstanding. On average, their vessels are about 9.8 years old, while the expected life of such vessels average around 25 years. It's like having a fleet of used cars, and the older they get, the more expensive they are to keep running, which could have a material adverse effect on the company. We can see some important information listed in this section that will come up later in our review. Alright, let's get to the numbers. It is here that we see a big picture of how the company performed. The total revenue from time, charter, and voyage for 2020-24 was $1,334, $306.9 million in 2023. So on the surface, it looks like they did slightly better. Keep an eye on those pesky exchange rates because they get paid in US dollars but spend in other currencies. Changes in currency values can eat into their profits. And as for governments regulating greenhouse gas emissions, those could require them to make significant financial expenditures which can't be predicted with certainty. They depend on limited liner and oil companies for the majority of their revenue. They have a good amount of fixed day for 2025, particularly in container ships. They have over $2 billion in borrowings. They need to maintain a required security of their debt and equity, have enough consolidated liquidity, and certain levels of net worth. It is important for the company to be in compliance with these or the company faces default. It is important to note that they believe they will remain compliant with all of those requirements that we just mentioned above. This is something important that could affect unit holders who may be asked to repay distributions in some circumstances. Their operations are impacted by economic sanctions, in particular because they have worldwide trades and a large number of counterparties. Their fees and reimbursements to their management company is a significant portion of their revenue. There are some disruptions to the global economy due to conflicts and potential terrorism. Due to potential upcoming regulations and new regulatory standards, the company might need to invest to reach the requirements. They have to watch out for international sanctions and compliance issues, particularly with places like Iran and Russia. Their boats can get damaged or destroyed. Their boats need to pass inspection. This entire document has been qualitative disclosures. The good stuff is here. A 6.4% increase of USD to Euro increased cost. You better bet they're keeping a close eye on this. We see the bulker and tanker rate cycles are not in sync, which helps diversify. The rates have also experienced the lowest annual average in 2021, which is a long time ago, and not representative of current financials. Their total borrowings are over $2 billion and they're sensitive to SOFR interest rates. Losing their CEO would be bad and could affect their ability to compete and grow, which is standard for any company. They do have some financial experts on the audit committee. So what's the verdict? Navios Maritime Partners is trying to navigate a volatile and increasingly regulated industry. They seem to be in a decent position to manage these risks, although rising costs and heavy debt loads may be something to keep an eye on. Their diversification could either be a strength or weakness, as management may get distracted, and it all really depends on who is at the helm. For now, it's another story for our Decoded. Do you think Navios can navigate all these choppy waters? What are your thoughts? Let me know in the comments below, and be sure to like and subscribe for more corporate decoder.